In personal finance, there are two big financial terms you have to know. Number one is savings, number two is investing, and exactly how to do this. Now, when you think of the savings side, both of them are essential when it comes to a financial strategy, but they serve very different purposes. And a majority of people do not know this. So, in today's video, we're going to be delving into what is investing, what is savings, and exactly which path is going to be the best to get you wealthy. And of course, knowing which option to use at what time is going to be imperative. So when we start off understanding the basics, so what does it mean to save money? This refers to setting aside a portion of your income, which is saved. This is going to be when you look at the NCUA, when you look at the FDIC, this is going to be your insured money. And this is going to be liquid, meaning you are going to have access to it whenever you need it. This could also be, and I highly recommend doing this in a high yield savings account. So as we sit today, M1 Finance offers high yield savings accounts right around 4%, which of course, when you look at the national average of where people have their money, it is 0.3%. When you think about having a savings rate as low as 0.3%, you are losing money and losing out on every single dollar that you're putting in that account because it is getting eaten up by inflation. This is where money markets, even possibly looking at certificate of deposits, depending on the money, which we'll get more into. Now, the primary goal of your savings account is to preserve your capital and have these funds ready when you have short-term needs, when you have an emergency needs. This is the reason why we have savings. Now, on the other side of it, when it comes to investing, this is money that is committed to really going on another endeavor, looking at growing your assets. When we think about investing in the traditional sense, we're talking about stocks, bonds, possibly doing real estate, investing with really the expectation of growing the income over an extended amount of time and creating a profit or creating essentially a secondary income when it comes to investing. The primary goal of investing comes into growing wealth over an extended amount of time. Now, when we think about investing and the time frame, I always generally use about 5 years. When we start thinking about savings, when you think about what do you need in the immediate, we're talking the next 1, 3, possibly even 4 years. This is where the savings comes in. If you're looking to save for a wedding, let's say in the next couple of years, you're saving for a down payment of a house, you're saving for a down payment to a brand new car. These are the reasons why you utilize saving. When you start looking at investment, like we said, with a 5+ really year time frame, because when it comes to investing, there are going to be a lot of ups and downs in the market, but we'll get into that. So when we start looking at the benefits of saving, so the big thing, of course, liquidity. This means you have unlimited access to the money that you have in there. The emergencies, both short and long-term emergencies, or some of those short-term goals that you're trying to hit are going to be the savings. If in the next 3 years you want to buy a house and you're starting to stock money away, that is the point of those high yield savings accounts. That is the reason to keep that money completely liquid. And of course, it is safe. When you start looking at safety, insured by, again, the FDIC, the NCUA, this is ensuring even if there is a bank or a credit union that falters, the money is still going to be protected. You don't have to worry about it. You don't have to worry about it going anywhere. And of course, you can do this with a lot of predictability. When you know exactly how much money you have in the savings account, there's not going to be a very big fluctuation, which is what we see traditionally when it comes to savings, or investing. You might see a fluctuation in the balance, and a lot of people emotionally or even mentally, psychologically cannot handle this. So if you put $1,000 in a investment account, all of a sudden you look and it's at $950. Some people will immediately pull the money out, realize that $50 really loss that they had. They will concrete it. They will say, we're not investing anymore. We're not putting any more money into it. Where savings, you are guaranteed to have that money sitting there for exactly when you need it. On the other side of it, when it comes to investing, this is a lot of the potential for higher returns. When we think about the stock market, have really provided higher returns than we see with savings accounts. This has been true for a lot of years now. When it comes to investing, like we said, a multitude of years, that 5+ year time frame. When we think of something like the S&P 500, on average, it has yielded about 10% return since inception. Even looking over the last 10 years, it's been about 11.5%, which of course is substantially higher than we see with those high yield savings accounts. But It hasn't provided 10% returns every single year. When we think about, the dot-com bubble, when you look at the housing market crash, when you look at, a lot of different adjustments, including COVID, there are a lot of times where the benefit of investing really does go down. When you see, and this is why we have that extended time frame when it comes to investing, but when you start seeing those balances go down, you have to stick with it. You have to think of dollar cost averaging. This is exactly the same utilization that we have when we're making 401k contributions. If you get paid every week, every 2 weeks, you are putting contributions into the market. Every 2 weeks, you are dollar cost averaging into the market, which is the reason why you can start building and really focus on the wealth accumulation. When we start thinking of compounding interest, it is the eighth wonder of the world. And it's incredible when you look at investing over an extended amount of time. And then when you start looking at, if you are looking at 20, 30, 40 years before retirement, you can grow some of these accounts with regular contributions in excess of $1 million for doing very little to nothing but making those contributions over an extended amount of time. Now, of course, to do this, you need diversification, spreading your money and spreading your assets across a multitude of places. It gives you a factor of really the risk mitigation of significant losses. This is the reason why when we start investing and when we start talking about ETFs, which are exchange traded funds, you are automatically diversified when you're putting something into that S&P 500 fund, such as that Vanguard VOO. You are instantly diversified because it owns the 500 largest companies in the United States, has the diversification of a lot of different sectors. Even though I know there is some of the specialization when it comes to technology and some of those larger companies, but overall, when you look at the risk, it doesn't have a super high risk. You're not putting all of your money into cryptocurrency. You're not putting it all into one basket. You're investing in the entire US economy. And of course, with this, inflation protection. This is something that a lot of people really do not realize. The returns from investment outpace inflation. If you're looking at inflation, even when it was super high, 8.2, 8.6%, it ensures the purchasing power is going to be there and preserved in the future because you are outpacing inflation. Again, just thinking generally with inflation, 2 to 3% is the target for the Fed. So if you're getting an average of 10% return over the last 30 years in an S&P 500 fund, and inflation is 2 to 3%, you're realizing gains of about 7 to 8% when you start adjusting them for inflation, making sure that money is really outpacing when you have your savings there and also your investment there. Now, when we start thinking why investing might be better than savings, this is, again, one of the big things that people have to look at. When you look at putting money in a traditional savings account, they are paying usually sub 1%. So every single dollar you're keeping in there, like we were talking about, is being eaten up due to inflation. If you're keeping it in there, you are going to lose out to inflation. Now, that doesn't mean go and invest everything that you have. This is where, of course, the emergency fund comes in. When you start looking at saving that 3 to 6 months of that emergency fund, it is imperative that it is invested into those high yield accounts, or essentially you're getting or beating out inflation at least a little bit while you're still keeping some of that money completely liquid. It offers a smaller amount of interest. You're not going to get the same growth and see the same diversification that you're investing in the stock market, but it offers higher return that can outpace inflation, meaning your money is actually going to grow into more money. Money creates money. If you've ever heard that, it is absolutely true, and we can see it as the stock market does increase in value. Now, of course, long-term growth. When we start thinking about long-term, we're looking at paying for, let's say, child's education. We're looking at retirement planning. There's going to be a point in time, trust me, there's going to be a point where you no longer want to work when you get ready to retire. Now, for retirement planning, it is going to mean something completely different for everybody. For me, might be able to generate $5,000 a month and be perfectly good because we don't have any bills. For other people, you might need a lot more money. And it also does make a difference. What kind of retirement do you want? Do you want one where you can openly, freely not worry about money, that you want to travel on a regular basis? That are things, you've always wanted on that bucket list. Having the funds and having the ability to do that comes from the investing side. Now, of course, to do this, what I'm doing personally is passive income. When you look at certain investments like dividend paying stocks, when you look at real estate, even looking at bonds, you can generate a steady stream of income. So you could get to the point where you're generating as much as you are earning as a regular paycheck working your 9 to 5 job, or even going above and beyond because of that compounding interest rate or that compounding effect that we have in investment accounts. You can actually get to the point where you're replacing a majority of your income with the passive income in dividends. Now, of course, when it comes to investing in the market, there are always considerations and risk. When investing, there are a lot of benefits, but the higher the risk, the more return you could possibly get. Investment accounts are going to go up, they're going to go down. There's always a possibility of losing money. You have to assess your risk tolerance. And this, of course, is a way to do it is when you start looking at risk, what would you be okay with losing? That is something to remember when you look at these financial goals. If you're an individual and you look at risk and say, I do not want to risk and I do not want to lose a single dollar. No point in time do I want to risk or lose any money at all. That might mean keeping all of your money into the savings account and not moving it into investment accounts, which of course, even though you don't want to lose any of that money, you're going to lose it because of inflation and it is going to be eaten up. Now, of course, there has to be a little bit of risk, but you don't want to go all out with too much risk. If you're taking your portfolio, your investment portfolio, putting it all into something that has a high volatility, there can be a high return. Now, when it comes to risk, me personally, might be worth a couple percent. I did put 5% into the IBIT, which of course is the Bitcoin trust, putting a little bit into Bitcoin. A lot of people are saying that is way too much risk. They would never do it. Most financial institutions are saying 1 to 2% to get a little bit of exposure to cryptocurrency. Other people are fine with 10 to 20% of the portfolio being into Bitcoin itself. So it is up to you assessing your risk tolerance and exactly how much you want. And with that, of course, you have to find the right balance. Most people, it's going to be a combination of savings and investing. You're going to have some money set aside, usually, again, about that 3 to 6 months of an emergency fund. Might be a little bit that is short-term savings. Again, if you're looking for a down payment for a house, looking for a down payment for a car, that vacation you've always wanted to take. There used to be a point in time, which is kind of crazy, but there used to be a point in time where people actually saved to buy the things they wanted. As we know in society today, it is about instant gratification. It is about buying it now, then spending the next 5 to 7 years of your working life paying for what you bought 5 to 7 years ago, which again is kind of crazy. Savings is absolutely crucial to really cover those immediate needs. And of course, offering safety if you do need money. Investment, however, is the key to building wealth. When it comes to big picture, if you're sitting on a ton of money on savings, let's say you got a year or two of savings, sitting in an account, not earning much interest, I advise you to go ahead, start investing that. It is going to grow and it is going to grow exponentially faster. Now, of course, before you do your research, make informed decisions, know exactly what your goals look like and what you're planning and what your roadmap is for retirement and everything else when it comes to life. Sorry, guys. So that is going to do it for today's video. If you like the content I'm putting out, definitely subscribe to the channel and let me know what you guys think. And I'll catch you in the next video.